You know what I find astonishing? Perfectly intelligent adults who can operate a smartphone, manage a career, raise children, and yet somehow believe they can outinvest the stock market while carrying credit card debt at 22%. It's a remarkable form of self-deception. Let me say this plainly. If you are paying 22% interest on debt and investing in the stock market hoping to earn 8% or 10%, you are not investing. You are performing financial theater. It's like trying to fill a bucket with water while there are holes in the bottom, and then standing there confused, wondering why it never fills up. The water isn't the problem, the holes are. I have spent most of my life watching people make money decisions in the wrong order. Not because they're stupid, but because they're impatient. They want the exciting part first. They want the story about the stock that doubled. They want to feel like investors. But investing properly understood is not about excitement. It is about sequencing. Before you invest a single dollar in anything, stocks, ETFs, crypto, whatever is fashionable this week, you need a financial foundation that does not collapse under stress. And that foundation begins with something so boring most people skip it entirely: an emergency fund. Now, I can already hear the objection. Cash earns nothing. Inflation eats it. It's inefficient. That's true and irrelevant. An emergency fund is not about maximizing return. It is about minimizing stupidity. When people lack liquidity, they make terrible decisions. They sell good investments in a panic. They borrow at outrageous rates. They compromise long-term plans to fix short-term crisis. The absence of a cash buffer doesn't just create financial strain. It creates psychological instability. And psychological instability is the enemy of rational investing. I would much rather earn 0% on a few $1,000s in a savings account than be forced to liquidate quality assets in the middle of a market crash because my car broke down. So, here is the sequence I recommend, and it is not complicated. First, save your first $100,000 as fast as you possibly can. That amount covers most minor emergencies, unexpected travel, car repairs, small medical bills. More importantly, it changes how you think. It gives you breathing room, and breathing room is underrated. Then build to 1 month of living expenses. After that, 3 months. For most people with stable employment, 3 months is a reasonable baseline. If your income is volatile, freelancer, commission-based, cyclical industry, you might need 6 months or more. This is not a one-size-fits-all exercise. It is a risk management decision. The point is not precision. The point is resilience. There is something else people underestimate: the psychological dividend of having cash reserves. Research consistently shows that even a modest emergency fund dramatically improves financial well-being. Why? Because uncertainty is expensive. When you remove immediate survival pressure, your decision-making improves, and good decisions compounded over decades matter far more than chasing an extra percentage point of return. Now, let's address the other leak in the bucket: high-interest debt. Credit card debt at 20% or more is not a minor inconvenience. It is financial cancer. It grows while you sleep. It compounds with mathematical indifference to your intentions. People love to tell me about the stock they bought that might go up 30% this year. I ask them what their credit card rate is. When they tell me 22%, I lose interest in the stock conversation immediately. Paying off a 22% interest rate is equivalent to earning a guaranteed 22% return. Show me a legal, repeatable investment that promises that, and I'll invest in it all day long. Even Warren Buffett, over a lifetime of extraordinary performance, did not average 22% every year. And he didn't do it by ignoring arithmetic. Carrying high-interest debt while investing is a form of denial. It feels productive because you are in the market, but economically you are running hay clear's throat in place, or worse, backward. So the rule is simple: eliminate high-interest debt before serious investing. List your debts. Pay the minimums on all of them. Then attack the highest interest rate first. That is the mathematically optimal approach. I don't care if it's glamorous. I care that it works. Now, There is one exception, and it's important. If your employer offers a retirement match, meaning they will contribute additional money, when you contribute, you take that match even if you still have debt. Why? Because employer matching is often a 50% or even 100% immediate return on your contribution. That is free money, and I have never objected to free money. If your company matches 50 cents on the dollar up to 6% of your salary, and you fail to contribute enough to get the full match, you are voluntarily turning down part of your compensation. That's not investing. That's negligence. Contribute just enough to capture the full match. Then redirect everything else toward eliminating high-interest debt. Once the debt is gone, you can increase contributions further. But do not skip steps. This is the part most people get wrong. They want to leapfrog the boring foundational work and jump straight into asset selection. They want to debate ETFs versus individual stocks while their financial structure is fundamentally unsound. I have never been impressed by cleverness layered on top of fragility. A sound financial life begins with stability. Stability comes from liquidity and the absence of destructive debt. Once you have those, investing becomes a strategy. Without them, investing becomes gambling with a veneer of respectability. So before you talk to me about the next hot opportunity, show me your emergency fund. Show me your debt balances. Show me that your bucket doesn't leak. Then we can talk about compounding, because compounding only works when the container is intact. Let me make something very clear. I have never met a person who became wealthy by ignoring arithmetic. And yet every year I see intelligent people trying to outsmart basic math. They carry high-interest debt and simultaneously talk about long-term market returns. It's as if they believe optimism changes interest rates. It doesn't. If you owe money at 18%, 20%, or 22%, that number is not theoretical. It is guaranteed. It compounds relentlessly. It does not care about your stock picks, your confidence, or your timing. And here's the uncomfortable truth. Most people aren't investing while carrying credit card debt. They're speculating with borrowed money. There's a reason I call high-interest debt financial cancer. It grows quietly. It spreads and it consumes future optionality. Every dollar you send toward interest is a dollar that never compounds for you. Let's do the math without emotion. If you invest in the stock market, you might reasonably expect 7% to 10% annual returns over long periods. That's not guaranteed, and it certainly won't arrive in a straight line. But if you pay off a 22% interest rate, you are effectively earning a guaranteed 22% return. No volatility, no uncertainty, no sleepless nights. That's a better deal than almost anything available in legal financial markets. I don't care how exciting your investment idea sounds. If the math doesn't win, I'm not interested. Now, some people argue, well, what if my investment does better than 22%? That's not how rational decision-making works. Rational people compare expected value with certainty. A guaranteed 22% beats a hope for 10%. And if you can't understand that you have no business allocating capital, there are two primary methods people use to eliminate debt. The first is the debt avalanche method. You list your debts by interest rate, pay the minimum on all of them, and direct every extra dollar toward the highest rate first. Mathematically, this is superior. The second is the debt snowball method. You pay off the smallest balances first for psychological momentum. Now I understand psychology matters. Humans are not spreadsheets. But if you can discipline yourself to follow the avalanche method, it will cost you less money over time, and saving money is generally speaking a good idea. But let me introduce the one major exception to the kill debt first rule, and it's important enough to stand alone. Employer matching contributions. If your employer offers to match a portion of your retirement contributions, that is an immediate risk-free return, often 50%, sometimes 100%. You do not ignore that. If someone offers to double your money instantly, you do not walk away because you're emotionally attached to your credit card payoff timeline. Here's how I think about it. If you earn $60 and your employer matches 100% of the first 4% you contribute, that's $2.400 of your money turning into $4.800 immediately. That's not market speculation. That's arithmetic generosity. Even if you're carrying 20% interest debt, a 100% immediate return dominates that cost. So the sequence is simple. Contribute enough to get the full employer match, not more, just enough to capture the free money. Then return with full force to eliminating high-interest debt. Once the debt is gone, you can increase retirement contributions aggressively. But until then, your job is simple. Stop the bleeding. Here's another thing most people misunderstand. High-interest debt doesn't just damage your balance sheet, it damages your psychology. Debt creates pressure. Pressure narrows thinking. Narrow thinking leads to short-term decisions. Short-term decisions destroy long-term wealth. When you eliminate high-interest debt, you aren't just improving cash flow. You are reclaiming mental bandwidth, and mental bandwidth is one of the most valuable assets you have. People often ask me, should I invest while slowly paying off debt? My answer is usually blunt. If the interest rate is high, you're not investing. You're hedging your own irresponsibility. I have always believed that avoiding stupidity is more important than seeking brilliance. Eliminating high-interest debt is not brilliant. It is basic. But basic done consistently beats sophisticated done poorly. Once your emergency fund exists and your expensive debt is gone, except for that employer match contribution, something interesting happens. Your financial life becomes stable. Your cash flow improves. Your risk decreases. Your stress declines. You are no longer running uphill on ice. Only at that point does serious investing make sense. And that brings us to the next layer, the part where most people accidentally overpay the government because they get distracted by shiny objects instead of optimizing structure. But understand this clearly. If you skip the discipline of debt elimination, everything that follows rests on weak ground. And I have never admired castles built on weak ground. Arithmetic first, discipline second, returns third, in that order. Now that you've done something most people never do, built liquidity and eliminated destructive debt, we can finally talk about intelligent investing, but not in the way most people expect. This is the stage where individuals get distracted. They believe the next step is selecting superior stocks or discovering some undervalued gem the rest of the world has somehow overlooked. That's amateur thinking. Serious investors optimize structure before they optimize selection. And the largest silent expense in long-term investing is not market volatility, it's taxes. The government is an unavoidable partner in your financial life. You don't get to vote them out of your portfolio. So the only rational move is to structure your capital in a way that legally minimizes their share. If you ignore tax efficiency, you are voluntarily compounding for someone else. Now, once you've captured your employer match, the next logical step is not to pile more money into your 401k. That surprises people. Instead, I prefer maximizing an individual retirement account, an IRA first. Why? Control and cost. Most employer 401k plans are designed for administrative convenience, not investor excellence. They often offer a limited menu of funds. Many of those funds charge expense ratios that quietly erode wealth over decades. 1 or 2% may not sound catastrophic, but over 30 years, that difference can cost you 6 figures. Compounding works both ways. With an IRA, you typically gain access to low-cost index funds and ETFs with expense ratios measured in basis points. You choose the custodian, you choose the allocation, you eliminate unnecessary drag. This is not glamorous, but it is powerful. For 2025, contribution limits allow thousands of dollars annually into an IRA. That money grows either tax-deferred or tax-free, depending on the structure you choose. And that brings us to a decision people love to overcomplicate. Traditional versus Roth, it's actually simple in theory. With a traditional account, you get a tax deduction today and pay taxes when you withdraw in retirement. With a Roth account, you pay taxes today and withdraw tax-free later. The question is, do you expect your tax rate to be higher now or in retirement? If you are in your peak earning years, high bracket, strong income, a traditional contribution may be rational. It reduces your current tax burden when it's most painful. If you're young, early in your career, and in a lower bracket, Roth contributions can be extraordinarily attractive. Paying tax at a lower rate now to avoid potentially higher rates later is sensible. But let me be candid. Predicting future tax rates decades ahead is unreliable. Governments change policies. Economies evolve. Life circumstances shift. So if you're uncertain, and most people are splitting contributions between traditional and Roth accounts, creates what I call tax diversification. Diversification is not just about assets. It's about flexibility, and flexibility is valuable. Now, let's discuss something that might be the most underappreciated investment vehicle available, the health savings account. If you are eligible for an HSA, meaning you are enrolled in a high-deductible health plan, you are sitting on an opportunity most people misuse. An HSA offers 3 tax advantages. First, contributions are tax-deductible. Second, the funds grow tax-free. Third, and this is the remarkable part, withdrawals for qualified medical expenses are tax-free deductible going in untaxed growth, untaxed withdrawals for medical costs. There is no other account that provides this triple advantage. And here is where most people squander it. They treat their HSA like a checking account for minor medical expenses. They contribute, then immediately withdraw to pay routine bills. That misses the point. If you can afford it, pay current medical expenses out of pocket. Keep the receipts. Let the HSA remain invested in diversified assets. There is no expiration date on reimbursement. You can reimburse yourself years, even decades later. That means your HSA can function as a stealth retirement account dedicated to one of the largest expenses retirees face, healthcare. And healthcare in retirement is not optional. After age 65, HSAs become even more flexible. Withdrawals for non-medical purposes are allowed. You simply pay ordinary income tax similar to a traditional IRA, but medical expenses remain tax-free. Given the trajectory of healthcare costs, having a dedicated tax-efficient reservoir of capital is not clever. It's prudent. Once you have maximized your IRA and your HSA, if eligible, then you return to your employer's 401k and begin contributing beyond the match. At this stage, something interesting happens. Your capital is no longer merely invested. It is sheltered. Every dollar you place inside these structures compounds without annual tax friction. Dividends reinvest untaxed. Capital gains accumulate uninterrupted. Tax deferral is not dramatic. It does not make headlines. But over 30 years, it is extraordinary. If you invest consistently inside tax-advantaged accounts, the compounding effect becomes significantly more powerful than the same strategy executed inside a taxable account. This is the quiet advantage intelligent investors build. And here's the uncomfortable truth. Most people never reach this stage. They never eliminate debt. They never fully capture employer matching. They never maximize tax shelters. They skip structure and chase performance. I have never been impressed by performance layered on poor structure. You do not build wealth by swinging harder. You build it by reducing friction, emergency fund, debt elimination, employer match, IRA, HSA, then expanded 401k contributions. That is not exciting, but it is rational, and rationality, applied consistently over decades, is very difficult to beat. Now we arrive at the place where most people want to begin. The taxable brokerage account, individual stocks, options, cryptocurrency, speculation disguised as research. This is where the adrenaline lives, and this is precisely why it belongs at the end of the sequence, not the beginning. By the time you reach this stage properly, several things should already be true. You have liquidity. You have no high-interest debt. You are capturing free employer money. You are maximizing tax advantage compounding. If those boxes aren't checked, you are not investing in a brokerage account. You are gambling with structural weaknesses. Now, let's be fair. Taxable accounts are not evil. They are useful, in some cases essential. They offer flexibility that retirement accounts do not. You can withdraw funds at any time without penalties. There are no contribution limits. They can bridge early retirement years. They receive a step up in basis for heirs, which can eliminate capital gains taxes at death. That last feature, incidentally, is one of the most powerful estate planning tools available. But flexibility comes at a price: taxes. Every dividend paid into a taxable account is subject to taxation. Every realized capital gain invites the government to participate. Every portfolio adjustment can trigger friction. It is what I call tax drag, and drag is the enemy of compounding. Let me give you a simple illustration. If you invest consistently for 30 years inside a tax-sheltered account earning 7%, the full 7% compounds in a taxable account. That 7% may effectively become 5% or less after dividend taxes and capital gains friction. 2 percentage points sound trivial. Over 30 years, they are not. Compounding magnifies small differences into enormous gaps. People obsess over finding investments that outperform by 1% annually, and then they ignore a structural inefficiency that costs them 2%. That is not rational behavior. Now, here is where things become dangerous. Once someone opens a taxable account, they often assume access equals competence. They begin trading frequently. They chase trends. They overestimate their insight. The availability of tools creates an illusion of skill. The market is very good at humbling people who mistake activity for intelligence. If you are going to use a taxable account wisely, keep the same principles that got you here. Low cost, broad diversification, tax efficiency. That often means index funds, tax-managed ETFs, minimal turnover. You do not need complexity, you need discipline. Now there is another psychological trap here. People think the brokerage account is where real wealth is built. That's nonsense. Wealth is built through consistent savings, disciplined structure, and decades of compounding. The account type is secondary. By the time you are investing in taxable accounts in a rational order, you are no longer trying to get rich quickly. You are scaling intelligently. Taxable accounts become a surplus engine. They allow additional capital to grow once all optimal shelters are filled. They are the seventh step, not the first. And here is the complete sequence without drama. First, establish an emergency fund. Second, eliminate high-interest debt. Third, capture the full employer match. Fourth, maximize your IRA. Fifth, maximize your HSA if eligible. Sixth, increase 401k contributions to the limit. Seventh, invest additional funds in a taxable brokerage account. That's it. Notice what is absent from this list. There is no step that says find the next Tesla. There is no step that says time the market. There is no step that says speculate aggressively, because most wealth is not built through brilliance. It is built through avoiding stupidity in the correct order. I have said for decades that it is remarkable how much long-term advantage people like us have gotten by trying to be consistently not stupid instead of trying to be very intelligent. This investing sequence is simply applied rationality. You remove fragility. You eliminate guaranteed losses. You capture guaranteed gains. You optimize structure. Then, and only then, you allocate excess capital flexibly. If you follow this order for 20 or 30 years, you will not need a miracle stock. You will not need perfect timing. You will not need genius. You will have something better, structure. And structure compounded patiently is extraordinarily powerful. Most people fail not because investing is complicated, but because they insist on doing it out of order. Do the boring things first. The exciting part will take care of itself.